Airwolf, Magnum PI, The A-Team, Simon and Simon, Chips, a collection of some of the greatest television dramas, the height of Western culture. Yes and no. Yes, for obvious reasons. No, because this is making sense. A Eurodollar University project with Jeff Snider, head of global research at Alhambra Partners. And therefore, Chips is not about Eric Lestrada and Larry Wilcox. It's not about wearing shirts that are one size too small. And those what are the breeches, tan breeches with the brown leather patches that are also way too tight that no self-respecting California highway patrolman would wear outside of Hollywood. No, Chips is about the clearinghouse interbank payment system. Jeff, why are we talking about the clearinghouse interbank payment system?
Well, I think we should talk about not just the height of Western culture in those shows, but also the theme songs, right?
Oh,
I think that's what most people remember most about those shows. I couldn't tell you the first episode of, or any episode, recall any episode plot line from Chips or the A-Team, but I sure know the theme song by heart, right? And it doesn't
Knight Rider. Did I mention Knight Rider?
Knight Rider, yeah, that's another good one. Back when theme songs were as important as the show themselves, maybe even more important than. And I think that's kind of the idea here is that, you know, we know the initial cursory background forward facing parts of some of these systems, but do we remember or do we recall or do we even know what really goes on in them or behind them or, you know, the details and all that other stuff? And I think that's where it really becomes interesting when you start thinking about what the hell is Chips? What is Fedwire? What is SWIFT? I mean, people talk about SWIFT when you think about the dollar system. What actually does SWIFT do? We know the theme song, but we don't really know the episodes.
And so we're going to tie it back to present day and why all of those messaging, bank messaging and payment systems matter. And we're going to start with a story, much like some of the shows that we mentioned, with something happening in the 1980s, something going wrong at the Bank of New York. What happened November 20th? I should have looked up what show was playing on November 20th, 1985. But what happened other than what wasn't on television?
1985, Bank of New York was a regular day, except for if you were in the back office, if you were one of the computer programs or one of the many clerks that is assigned to look at the computers and settle treasury trades, it was probably the worst day of your entire career. Essentially a software glitch, and I mean, they specify, there's all sorts of these stories about what the software glitch is, and I don't really understand much about it. But anyway, it was a heavy volume day in treasuries in 1985, as you might imagine if you know what was going on in November 85. And the Bank of New York found itself trying to process 32,000 trades, which, I mean, today that's a microsecond worth of transactions. But back then, that was quite a lot. And so it has tripped up the computer system, and that caused also a chain reaction, which led to Bear Stearns drawing from the discount window a then record amount. And you wonder, well, how does a software glitch end up with Bear Stearns essentially being bailed out by the Federal Reserve?
Well, it has something to do with the timing of all these things and a daylight overdraft. And that's going to be important. Part of our story is what happens during the day, because you'll explain to us that, you know, at the morning, everything is settled. And at the end of the day, everything is settled. But during the day, things are not settled.
Wild West free-for-all, essentially,
That's right. That's right. So tell us about that overdraft and why Bank of New York was, I think what happened was that they were extending credit, right? They were not getting the cash in. You tell us.
Yeah, and it's almost like, you know, we talk about quarter-end window dressing. We pay attention when banks report. And so they report as quarter-end. And what goes on during the quarter, who the hell knows? And it's the same thing day to day. You know, everybody knows what everybody's done the day before. So we know what everybody is at the open. And then we know, because there's reporting at the close, when everything gets settled out and shaken out, we know what everything happens at the end of the day. But what goes on in between is sort of, you know, a big guesswork mystery. And the reason is, you know, we have these automated systems. And going back to the Bank of New York, November of 1985, what the software glitch did was it made it impossible for Bank of New York to reconcile treasury trades. So customers called up their Bank of New York and said, look, I'm buying a treasury from whoever else, go into the marketplace and buy it for us. And Bank of New York arranges, the broker arranges the buyers and sellers together. And Bank of New York actually clears the buyers and sellers, exchanges cash for securities, because Bank of New York was one of the primary four primary back office custodians at that time. They were in charge of settling and clearing all of these treasury transactions. Now, because of the market uses a DVP system, which is delivery versus payment, what that means is when the seller gives his treasuries to Bank of New York to then forward on to the buyer, the seller receives his cash from Bank of New York's account. When Bank of New York has no problem doing it because, computer software and everything else being what it is, they imagine I'm going to find the buyer at the other end at the same time, and so I'm lending credit to the seller, and I'll get the funds back from the buyer, and I'll make a little bit of a couple pennies on the transaction along the way. But the software glitch prevented Bank of New York from matching seller to buyer. So all of these trades were selling treasuries, which meant Bank of New York kept fronting more and more and more, crediting more of these sellers' accounts, but it wasn't getting any money coming in because it couldn't find the buyers. Now, it knew the buyers weren't, they didn't disappear. It's just the software couldn't trace their accounts and figure out who do I need to deduct funds from. And so by the middle of the day, not the software glitch I think it was something like 20 billion by 4 o'clock. That's how much Bear Stearns had extended in what, as you mentioned, Emil, 20 billion in a daylight overdraft, which daylight simply means during the day. They were extending 20 billion in credit they didn't have. So, and $20 billion in 1985 is a lot of money.
Specifically, you said that so by 2 o'clock in your article.
By 2 o'clock was 20, and they started to fix some of the software issues and started to reconcile the database and get things moving. And so by the end of the day, I think it was 8 o'clock at night, or maybe a little bit later, they were short of 20 up to 30 billion. I think it was at the maximum. Right. And they started settling some. They got some buyers.
Yeah, at 8:30 they were short 30 billion, and you said it's a 32,000 trade car pileup that they're sorting through, worth 20 billion at 2 o'clock. By 8 o'clock, 8:30 had grown to 30 billion, and at 2:30 in the morning they had gotten it down to 22.6 billion. And as you mentioned here, 22.6 billion is your typical amount in a CHIPS episode for like a ransom, but it's also worth 1.5 times the book value of the Bank of New York.
Yeah, so I mean, it was a major thing, massive thing. And by 8 o'clock is already after the settlement, final settlement times, and so Bank of New York was already being given special dispensation to try to work out its custodial and settling issues, and that extended all the way to 2:30 in the morning, which by then, it wasn't just Bank of New York who had extended intraday credit to customers. Because Bank of New York didn't have those funds, it was actually the Federal Reserve Bank of New York, which had ultimately the liability for what was going on, because this is all done during using the Fedwire system, which the Federal Reserve stands behind and says we're going to guarantee all payments and processes there. So essentially, this wasn't just a problem for Bank of New York, it was a problem for the Federal Reserve, because all of a sudden, late at night, they're getting phone calls from counterparties trying to settle with Bank of New York, and they're hearing noises that the Bank of New York can't even settle its own trades intraday. Daylight overdrafts that are $30 billion in 1985. I mean, you can imagine the amount of sweat pouring out of Gerald Corrigan's forehead, who was the president of Federal Reserve Bank of New York, realizing that what was likely to happen would be that Bank of New York, one of the most basic, most fundamental pieces of the entire financial system, was going to have to go on the books at the discount window, borrowing about $23 billion. And what would that do to the rest of the financial system?
I think it's an important moment here to point out that it's the complexity of the system that puts everyone at risk, right? Bank of New York, fine bank. But it's so complex that something goes wrong. And as you mentioned, Corrigan realized, well, if Bank of New York goes down, no big deal. No, Bank of New York is networked, interconnected with everyone. And that could bring down the system. And he mentioned, quote, because he testified in front of Congress.
Yeah, Congress
as you
got
mentioned.
involved. I mean, this was, and people don't, I'm sure most people have never heard of this episode, but this was another one of those things that goes on in the shadows and in you know, the plumbing issues that, you know, people who do pay attention said, oh my God, what the hell just happened? This is a big deal.
And Corrigan said the result was a backup in the willingness and ability of some other market participants to transfer securities amongst themselves. All of a sudden they said, we don't like what's going on in this system, even though we have nothing to do with it, but we're connected to the system, and therefore we're stepping back. And you can see how this could cascade, and it's foreshadowing how we're going to link it to present day. But instead of talking about present day, let's go all the way back to 1918, the Fedwire. You introduce us to the Fedwire, to Telex, which is kind of a European, well, they're different, right? One's a messaging system, one's a wiring, or maybe they're the same. Then you introduce us to SWIFT. Can you sort of just tell us that history of what these systems were trying to accomplish, and then where chips comes into this story?
Well, it's essentially a story about how money moves, right? Mm-hmm. I think most people will think, when they think of the banking system, and we're taught to think of them as individual banks, right? We have an individual bank, it has its customers, and therefore that bank, really all it has to worry about is managing payments for, you know, managing liquidity needs for its customers. When the truth is, going all the way back to the 19th century, this interbank way of managing the payment processing system has been, you know, one of the key factors driving banking evolution, the ability of the monetary and banking system to create a national, then an international economy. It all goes back to the efficiency of money to move around from one place to another, so that real economy participants can do real economy things without having to worry about, oh, do I have to ship gold across the country? Do I have to write a check? You know, if I'm selling goods to a customer in California, do I have to wait for the check to clear? I mean, does it, you know, I mean, there's all sorts of inefficiencies and frictions that arise from these payment issues. And Fedwire in 1918 was introduced to start to, you know, to smooth out and make more efficient these payment requests, because it allowed at least the Federal Reserve branches to send instantaneous messages between each other, which said, hey, my bank over here in my branch needs payment from your bank over there in your branch, so send me the funds. So at least if we can get the banks talking in real time, then we have a much more efficient system, because we can settle all these payment needs and move money around all over the place, which is really what a modern economy needs. It needs money to flow around. It needs to be fluid as well as efficient. And so these interbank payment systems were created so that could happen. And one of the key factors spurring even further growth in it, leading up to chips and SWIFT, was this thing called Eurodollar. And the fact that this dollar-based interbank payment system was no longer strictly an American thing. It suddenly became a global issue, such that, you know, the Telex system was, in its day, it was a very innovative system, but you got to remember that it started in the 1930s, which was essentially what we think of today as text messages. So that's really all the Telex system was. It was an internet of text messages, and we were trying to send funds between accounts in different banks. And there's no real standardized format, and it also comes out on a piece of paper. You have to have a human read essentially a text message. You can see there's limitations in how many payment requests and how many messages can be processed. And I believe it was said that it took about 10 Telex messages just to make sure that we're accurate. We know exactly the details of what's trying to happen. And so, given all these limitations, moving into the modern digital age using computers, these interbank processing systems began to be automated. But in order to be automated, what you have to have is standardized messaging. And that's really all SWIFT was a consortium of a lot of banks around the world that got together and said, let's standardize our messaging protocol, so all it takes is one message, so that the sender and receiver both know exactly what needs to be done. And that's really all SWIFT is. SWIFT is not a payment system, it's a messaging system. It's a standardized messaging system for US dollars, for global banks all over the world. I believe there's 8,500 or so members participating in it today, so that they can send and receive messages from each other saying, look, I have a customer that's sending dollars to you. I'm going to forward them to your account, your Nostra account, so you can put them on behalf of your customer. It's really SWIFT is where the interbank system begins, not where it ends and not its totality. And of course, then we get into things like CHIPS. Now, CHIPS is actually sort of a competitor to Fedwire, but it's also a messaging system, and it's also more it's focused more so on international dollar trade. I think it was 90 or 95% of all U.S. dollar interbank settlement takes place across the CHIPS system. So you have to be able to you have to have an ability for banks to talk to each other, to tell them, what are our customers doing? What are we doing with each other? If I'm engaging in a repo trade, for example, how are we going to settle that? How are we going to move funds? How are we going to net funds out? And remember, that's the other part of this. Is not just two banks talking to each other. It's every bank talking to every other bank. And so you have thousands upon thousands, if not millions of potential transactions that if you had to settle them one at a time, each bank dealing with each bank on a bilateral basis, it would require an enormous amount of float because you'd have to have so much cash in reserve to settle each and every claim. It's so much more elegant to net them out, to have a way to everybody throw their claims into a pot, in a central cleared pot, and just decide, okay, I'm going to net out this one against this one and this one against this one, and we'll just decide at the end of the day who owes what. Sort of like settling up at the end of a poker game. How much chips do you have at the end of the day? So you're owed however what. And that's really all chips is. It's a way for all of this stuff to be netted out and settled so that we don't have to have a massive amount of cash and reserves tied up in float. And I think it was said that for every $100 in gross transactions demanded, using these gross netted central systems, you only need $1 in reserves because it's so easy just to net out counterclaims.
Now, but this is a fabulous system, but it requires that each participant behaves in a certain manner. Otherwise, if they don't meet the requirements, then the system could cascade apart and fall apart. And so here you explain that beginning at 9 p.m. the night before each morning's deadline, which is at 9 a.m., every CHIPS user must deliver via Fedwire its opening position requirement to the CHIPS account at the Federal Reserve Bank of New York. This is pre-calculated, and no bank can send or receive payment requests until further funds are obtained. So you know the night before how much money you have to send by 9 a.m., and then you can participate in the system. And then there, at the end of the day, at 5 o'clock, they figure out what the total netting is, and perhaps a few hours later, you have to send money or you will receive money. Is that right, Jeff?
Yeah, it's actually more elegant than that because they actually net transactions during the day. Mm-hmm. So while all these messages are being transmitted back and forth, the CHIPS algorithm actually nets out as many transactions as it can during the day. And so you have the ability, at least in the modern system, to in real time manage your liquidity profile. So you have an idea when we get to the end of the day, what are you actually going to need to put up? Because at 5 o'clock, CHIPS says no more messages. Interbank trading is done, so all the payment messages cease, and then any messages that haven't been netted out previous to that, then they start to bilateral net or multilaterally net everything else, and then tally up your closing reserve requirement, which basically says by 6 o'clock you got to put money into. If you're negative, if you have more payment requests than funds coming into you, you're going to have to, assuming it goes beyond whatever reserve you put up in the morning, you're going to have to put up more funds into the CHIPS account at Federal Reserve Bank of New York via Fedwire. And same thing on the other end. If you end up having more payments coming into you than are leaving, then you have a positive closing number, which means that CHIPS are going to send to you via Fedwire funds that you're owed. And so at the beginning of the day and the end of the day, the CHIPS account at Federal Reserve Bank of New York is zero. It always ends up in zero. But as you pointed out, Emil, during the day, these banks are essentially extending credit in real terms and in virtual terms too, because every payer is essentially saying, look, I'm depending upon you to lend me intraday credit. because these funds, theoretically, don't get settled into the end of the day. So during the day, I'm expecting you to send me cash at the end of the day through the chip system, but during the day, I might let customers use funds that they're anticipating coming in. I might do also all sorts of other things. So during the day, as we talked about in the Bank of New York example, there's all sorts of intraday credit being extended that isn't really tracked. Now, I want to make clear that the chip system, like the Fedwire system, has lots of risk controls in place to make sure that something like the Bank of New York episode doesn't happen again. There's position limits and extension limits, but they do their best to monitor the levels of potential daylight overdrafts. But that kind of thing has it has behavioral aspects to it, as we talked about before. Look, if I'm way overextended, or I'm getting further and further overextended in payment requests that I didn't anticipate, that's going to cause me to do some other things. It may, as one Federal Reserve Bank of Chicago paper said, negative externalities, where in certain cases, not wanting to go to the Federal Reserve to have to borrow funds to settle at the end of the day, we might delay payment messages on the other side, the counterparty who's originating the message. And what that means is we're introducing frictions into the payment system. And obviously, we're going to ask the counterparty to do that because I'm giving them something, usually collateral, by the way, so that they don't present for payment immediately whatever message through the chip system. So there are frictions that come about from overnight drafts and daylight credit that are induced because of the fact that this stuff needs to take place sort of in the dark or sort of in the day, during the day, when we don't really have a systemic or overall sense of what's going on.
And you mentioned collateral there, and that's an important part of this paper, is that you say that the Federal Reserve and regulators are kind of looking at the system from the point of systemic failure, should it occur, and they're looking at banks. Like if a bank would go down, how do we prevent that from radiating out through the liquidity pond here? But you mentioned, well, okay, so say a bank needs to make good on the funds that it's being drawn on, it may have to go out and secure funding. And how would it do that? With collateral. And they're not looking at that, are there? The collateral. Like if we had a Bank of New York situation today, they would have to go get collateral for funding. Where would they get that? That I think, and
yeah,
then
let's explain that a little bit more detail. So at the end of the day, chips is netted out, and you owe a bunch of cash because for whatever reasons your bank's customers had spent a lot of money, and now you're being their cash is moving to another bank, and that other bank is saying, I need those funds because customers have transferred the funds. And so at the end of the day, you've got an unanticipated withdrawal, and it's more than the amount of reserve that you put up at the beginning of the day, which means you have to settle this deficit, and you have to do it immediately. I mean, this has to be done immediately. And what the Federal Reserve expects that you're going to do that one of three ways. You're going to borrow the funds in the federal funds market, which is unsecured. You're going to go into repo and borrow the funds in repo, or you're going to go to the discount window and borrow the funds, as Bank of New York did, from the Federal Reserve, largely the Federal Reserve Bank of New York, but it could be one of the 11 other Federal Reserve branches. In other words, if you're deficient at the end of any single day, you have money markets or the Federal Reserve to obtain cash such that you can settle up, transfer those funds via Fedwire to the CHIPS account, and so CHIPS stays neutral at the end of every day. But that, we know what federal funds has done since August of 2007. It's no longer really a marketplace.
Tell us a little bit more, just a minute, because maybe we haven't discussed that in a recent episode. So federal funds used to be very active, but now?
Yes, federal funds used to be a very dependable, vibrant, dynamic marketplace where these things, if you were short at the end of the day, you had no problem. You were a bank in good standing, good reputation. Because federal funds is unsecured, you could contact whoever it was and say, look, I need to borrow some funds from you because I'm short. I have a daylight overdraft that I need to cover. And that would be easy to arrange. But beginning in August of 2007, August 9th, 2007, the unsecured markets, and especially federal funds, essentially broke down. And so since that time, there really isn't much money in there. There isn't really much trading in there. It's really mostly GSEs who have spare cash, who are prevented from using IOER. So there really isn't that option anymore. And even if there was, as you know, you go into the federal funds market on an unsecured basis, I'm not sure you get a good enough rate, especially if you're going into the federal funds market saying, I have a daylight overdraft that's more than I anticipated. I don't know how many people are going to jump all over the chance to lend you unsecured. So federal funds is out.
Jeff, let me just quickly interrupt. It's not there, that money isn't there because before 2000, August 9th, 2007, banks believed in growing their balance sheets, in globalization, in a world of return. But after that, they believe in deglobalization, a world of risk. And because this is an unsecured market, after what they saw happen in 2008, they don't want to put themselves at risk. Is that right?
Yeah, it's an unnecessary risk, right? Okay.
So
instead, you can go to repo.
Options. Yeah.
So
repo.
If you can't do it unsecured, then borrow in secured markets, which means you go into the repo market, you post collateral, they give you cash, you then transfer the funds via Fedwire to chips, and everybody's happy. Except if you don't have collateral. If you don't have collateral, you're not really sure you can get collateral, then you're not going to be wanting to put yourself in a situation where you may end up with an unanticipated daylight overdraft because you're not certain you could settle it in repo. And if you can't settle it in repo, what do you have to do? You're at the Federal Reserve's discount window, which is now called primary credit, and that's a death sentence. That's
why is it a death sentence?
Because the stigma associated with the discount window had become so. And ironically, it's because of the federal funds market. Because you could go into the marketplace and obtain funds that you were short of to settle on the daily basis, what the market said was, if you have to go to the discount window, that means that the marketplace has already said it doesn't want you. And so if you're at the discount window, that's your last resort. And the market is then going to look at you funny because it says, you have no other options except the discount window. Nobody's going to lend to you because we don't know what really is going on there.
Right, and they'll start withdrawing funds from you over the coming days.
Exactly. So the stigma associated with primary credit is essentially a death sentence. And so you really can't go to the discount window except in exceptional circumstances like Bank of New York did in 1985 when they could say, well, this is just a computer error.
Right.
So if you have any operational problems that arise and you're stuck at the discount window trying to borrow large sums of money, that's really not an option for you either. And another thing we need to keep in mind too is, who are we really talking about here? We're not talking about Lehman Brothers or even JP Morgan or even Bank of New York Mellon as it's known nowadays, because those banks are flush with excess reserves. That's where the bank reserves come in from the Federal Reserve's quantitative easing. Those banks have enormous balances of excess reserves. They're never going to have to worry about a daylight overdraft, or if they're extending daylight overdrafts, because they have all the bank reserves they could ever need to settle up at the end of the day, because it's already bank reserves. It's easily transferred via Fedwire into the Bank of New York, Federal Reserve Bank of New York on the behalf of chips. And so it's not the big dealer banks that are short of cash. It's everybody else. That's really when we get into this idea of abundant reserves, as it's been called since 2008. What do we really mean when we say abundant reserves? What it means is that systemically, it looks like they're abundant reserves, but they are not evenly distributed, are they? In fact, they're actually concentrated into a very small number of players that doesn't actually, at times like September of 2019, for example, the dealers might say, well, we've got abundant reserves. We don't know what the hell's going on with the rest of you people because you can't post collateral in repo, so we're not going to extend these. We're not going to extend these abundant reserves to the repo market, because why the hell would we, right? And so what we're really talking about is there is more monetary considerations that go way beyond the Federal Reserve, even Fedwire, and bank reserves. Why are potentially interbank counterparties outside of those primary dealers, especially these global participants of banks around the world who have subsidiaries in the United States that are participating in chips as non-settling members, they have all the sorts of potential for running short of liquidity, where in the modern post-2008 global dollar shortage situation, they would react harshly to even the probability of being short at the end of a day's settlement, especially if they're concerned about collateral availability, which is a completely other story that we just won't have time to get into here. But suffice to say, what we're really talking about is the complicated nature of these systems, and that there's opportunities for all sorts of illiquid behavior, negative externalities to impose themselves on the monetary system on just a daily basis.
And that you believe that best explains the nuts and bolts of what happened in September 2019, the repo issue. You think,
right? If you're a dealer, if you say you're J.P. Morgan, for example, the repo issue wasn't you. You weren't the one who was short of cash because you have abundant reserves. You can make any liquidity shortfall you have. You just transfer the funds in your bank reserves to whatever, through Fedwire to chips. But if you see, okay, there's a lot of my non-settling member counterparties are starting to build up daylight overdrafts, which you can kind of monitor during the day. And they're having trouble going into repo, right? Because they're going into repo because they can't go into Fed funds. And that starts driving the repo rate higher because there's so many of these people running into repo at the same time. You wonder what's going on here. Why are all these people desperately trying to avoid using primary credit or the discount window, that they're borrowing so heavily in the repo market to avoid having a situation where they're short at the end of the day and they can't settle up at chips or Fedwire or anyplace else? Because it's not just chips and Fedwire. There's also all these exchanges like the Chicago Exchange, ICE, all these financial markets where where daylight overdrafts could possibly arise, and you have to settle somehow there too. So what we're really saying is it's not the big banks that are short of liquidity. It's the big banks who, when everybody else is short of liquidity, don't offer it to the rest of the system like they're supposed to. That's really what money dealers are supposed to do. And one reason is that the system does not work the way it used to. It's not as dependable and fluid and liquid, despite the fact that there are abundant bank reserves, because abundant bank reserves don't tell us the entire story.
There's just too much risk out there that they don't want to take.
Exactly, Emil. It's as much a behavioral change as it is anything to do with its balance sheet changes, right? And balance sheets are governed by perception of risk and behavior. But balance sheet capacities and the way opportunities are potentially viewed in a risk-adjusted scenario post-2008 is not the same as it used to be. And so, going back to our original story here, the payment system, liquidity, what do these things actually mean? It's fluidity and efficiency across a global economy. And if we start introducing frictions, even tiny frictions that we can't really observe, what does that do to commerce in general? It slows it down. And it slows it down in such a way that it's noticeable, even if we don't notice what it is that's actually slowing it down. And that's, I think, the overriding point here is that this, the focus on illiquidity is if we don't have a Lehman Brothers, then the system must be liquid. And it's not that's not the case. There's gradation. There's all sorts of a whole spectrum of illiquid behavior that can build up over time. And it's not necessarily just that when we see the most extreme outbreaks of these things, that's the only time that the system is illiquid. There are all sorts of minute ways that these things pile up, and it does cause a drag on real economic activity.
It's a lack of confidence that the banks have in their central banker to be able to backstop the system based on recent experience. And so despite the central...
I think that it's worth going into even a step further that I didn't go into the articles. If you don't want to go to primary credit and the Federal Reserve knows you can't go to primary credit, then you have to wait for the central banker to offer you liquidity. And that's really what happened in late 2007, is that, okay, the banks couldn't go to the discount window, even though the Fed changed the formula for primary credit that reduces the penalty rate by 50 basis points. Banks still said, we're not going, because this is a death sentence. And so we have to wait for Ben Bernanke to get off his butt and start offering TAF auctions and dollar swaps. That's not a situation you want to be in either. My entire existence depends upon, okay, I can't go to the discount window. I can't go to repo. Now I got to wait for a TAF auction. And oh, by the way, TAF auctions are determined by bureaucracies, which means they're fixed allotment or fixed rate or whatever. It's a bureaucrat offering liquidity to a system that needs dynamic. So it's really not a substitute either. And that's really a bad situation to be in. I think that's one of the reasons why it was a systemic rupture in 2007, 2008, was because even on an intraday basis, banks realized, oh my God, federal funds is dead. Repo's now a problem. I have no backstop in the Federal Reserve. I got to wait for them to do a TAF auction. I need to cut back. I need to change how I manage my money dealing activities right down to the ground, because operationally these risks have built up that we didn't think were there. They're now being proved as completely big. I mean, I don't want to be the next Bear Stearns.
And you would think, had that been the end of it, about half a generation has passed, we might be able to move forward. But as you often write in your at your blog post at Alhambra Partners, that was episode 1. Then we had episode 2 in Europe, then episode 3 in Asia, and episode 4 most recently. So it just keeps happening. We need some sort of new paradigm, a new social contract, a new institutional order. Jeff, is there anything that we didn't cover in this article that you wanted to mention before we move forward?
No, it's really just, look, this is a very complicated system. And what we're taught is that it's not. That the Federal Reserve pushes a button, prints some money, and voila, the world just works the way it's supposed to. And it's not about bank failures. It's not about the big things. It's often about the little tiny details that pile up over time. And as you just pointed out, Emil, we're 12, 13, running on 14 years later, and we still have the same problems. And the problem is that you can't fix it with just abundant bank reserves that pile up at certain banks. It's really, why is collateral such an issue? Because it prevents, if we have a shortage of collateral, it prevents people from getting into repo when they really need to get into repo. And if they can't get into repo and they can't go to the primary credit, then they start cutting back their own activities, because they can never be in a situation where you can't settle at the end of the day because you're out of business.
Jeff, let us now pivot away from 1980s television shows to endangered species. Just a typical making sense Eurodollar University episode. So here, part 2, what are we going to talk about? We're going to talk about the endangered gazelle, which was last spotted in Las Vegas. Very confusing. I know there are no gazelles in Las Vegas.